Welcome back. You're watching Stock Picks, and today we unpack Reinet, HCI and Brait with Financial Mail's Marc Hasenfuss. Marc, always a pleasure. Thank you so much for being with us today.
Pleasure to be here.
Fantastic, Marc. So I do notice that these are all holdcos. I'm keen to get your thoughts on the overall, reason for picking these ones at the beginning of the year, actually.
Well, I'm big on discounts. I like buying things cheaply. And I think at the moment some of these are quite cheap. Not all of them. I'll come to that in a moment. But I like holdcos. I prefer them to unit trusts. I think in some of the holdcos in South Africa, and I'm not the ones I've mentioned yet, something like Remgro, I think if you're starting a share portfolio, it should be the first share you buy. You're getting a spread of everything, decent businesses with good cash flows, very dependable management, fairly good capital allocation. I just think it's a good place to start. And the other holdcos are also interesting to look at if you break them down.
Keen to start looking off, maybe we can start off with Reinet. It's one that I would say it has a few things in it, but BAT, British American Tobacco, as well as Pension Insurance Corp are the real big ones in there.
Yeah, so Reinet, to be honest, it's a capital preservation vehicle. They've always said it from the very beginning. So you're not supposed to shoot the lights up. They're supposed to preserve your capital over a long period. And I think overall, I think it's done that. I think it's done about 8% a year. So pretty decent. The change now is that BAT was always the big asset. In fact, it was over 85% at first. Pension Corporation has turned into, which is a pension reinsurance business in the UK, has turned into one of their better investments. Now their biggest asset by quite a long shot, over 55%, I think, something like that, and I think BAT's down to about 25%. Now, the interesting development here is there are strong rumors, and there were reports that some private equity companies are looking to buy into Pension Insurance Corporation. Now, whether that entails Reinet selling all of their assets, not selling, just participating with new shareholders, it's not known at this point, but it's got the market quite excited. And the discount has narrowed quite considerably over the last kind of 6 weeks. I'll make the discount around 22%. Not too long ago, it was close to 40, maybe over 40%. So the market is anticipating something happening there, like a value unlock, or that a proper value will be accorded to Pension Corporation, which at the moment it's an unlisted company, and we've got to trust the valuation that Reinet give. And it could be conservative, it could be a little bit aggressive, who knows. But if a deal does come through, that'll be very interesting. And if you look at the movement in NAV at Reinet, I looked earlier, it was about, I think they did 2.1% over the last quarter. If you look at the last quarter on the JSE, it's done a lot more than that. I think something like 24%, and I think 44% over a year, which is a hell of a movement for an investment trust that people usually consider quite boring and stayed. So an interesting one at an interesting juncture.
What's also interesting, I think, Marc, for me, is just looking at BAT as a business. It is, I don't know if it's a transition phase or if it's just a wobbly time here, and that, in the future when vaping and all of it is cool again, I think lots of more people are vaping than I imagined, actually. When all of that is cool again, BAT may come back and become, one of those great blue chips. But for now, really in a bit of a weird spot.
Yeah, look, I kind of like that. I always have. I do understand that the vaping thing, it's not as easy as they made out. I think there's a lot of illegal activity in America, particularly. There are a lot of brands. I think the market's quite fragmented. Building market share might not be that easy. They seem to be progressing according to their plan, which is encouraging. But, they still do make a lot of money from the so-called combustibles in the emerging markets. We talk about, in the main developed countries, in South Africa included, there's a lot of regulation around tobacco, maybe less so in some of the other countries, and there's a lot of pricing power in cigarettes. The more the price goes up, the more regulations put on, the more tariffs are put on. The pricing power is incredible. It's an addictive habit, and thank goodness I don't smoke, but I know people who do, and they don't stop. And you'll pay that extra 30 cents, 40 cents, 60 cents for a packet of cigarettes. So it's got incredible cash flows, and they've got a very nice little investment in India as well, which people forget about, which might be quite valuable in the future and quite a good bargaining chip if there is any corporate action, or if they want to raise money to maybe buy back shares and maybe increase the dividends.
Fantastic. I'd like to move on now to HCI. This is a big oil and gas story. Well, that's been the dominant story around Reinet. I'm keen to get your thoughts on that. Lots of movement also. When I was reading about it, I was like, well, this is rather complex.
No, that's probably the problem. So yes, oil and gas, you make a big discovery, or sorry, you invested in a company that makes a big discovery, and everyone gets very excited. And people start talking about how many possible barrels of oil there are, and people get even more excited, and the froth just builds. Then the reality sets in. To participate in something like that, you need lots of money. Lots and lots of money. It's a very expensive exercise. It's very lucrative if it works out for you. But to stay in this business, you've got to invest in the further exploration, the production facilities, etc., etc. HCI have got a fair bit of debt at centre. They cannot afford to fork out more money, to be honest. So what they did was people expected them to sell their oil, part of their oil and gas exploration assets, especially the one in Namibia called the Venus. It's a Venus deposit, very rich apparently, but maybe not as rich as people thought. What they did do was they partially exited, and they will get possibly a small dividend payment out of that when money is paid back for their exploration costs from Total. But they are retaining a smaller interest in the business for the longer term. And that seemed to disappoint the market. I think people wanted a big windfall payout, cash, and then maybe a special dividend, or for them to settle debt and then maybe restructure the business, unbundling their subsidiaries, etc., etc. So that didn't happen. And I think the market's kind of watching and waiting, and it's a long-term play now. There is one curveball. They didn't, well, not HCI. They didn't say anything about the whole deal. They kept very quiet, but they invested in a company called Impact Oil and Gas, which is party to this big discovery. They have another shareholder called African Oil Corporation. And African Oil Corporation were hinting very strongly that they might buy we don't know if it's all or part of HCI's interest in Impact, which would obviously release some cash flow, and it'd be quite an interesting deal to see how they price something like that, because they'd have to price the promise of this Namibian oil field into that price. So a little bit in limbo at the moment. The share price has come down quite a lot. Difficult to get a handle on the NAV at HCI. The company's not always too helpful in that regard. So I think this one could drift and is one to watch if you like a long-term story.
What also interesting is they've got some really strong assets other than the oil and gas. I mean, if I think of Tsuhosan and E-Media and so on within that portfolio, would it also be wise at this point to possibly unbundle those, maybe keep them separate from the oil and gas? Could the valuation for those ones even, boost what we're seeing it do on the stock market?
Yeah, look, they can't unbundle while there's debt, so that's their hands are tied there. But having said that, you mentioned the quality of these assets, so, and you mentioned the ones that everyone knows, Sogo and Southern Sun and E-Media, which are all good businesses. But while this was all happening, and the market is registering its disappointment about no cash flow coming out of the oil deal, well, not up front at least. Very quietly, one of its subsidiaries, Frontier Transport, which owns the Golden Arrow bus service, declared a whopping special dividend, which will, I calculated, might be 250 to 280 million or maybe more to HCI, which helps oil the balance sheet, does help cut debt, and just attests to the quality of that asset. It is a good asset. They do really have nice assets and some good unlisted stuff as well in their property portfolio. They've got some interesting property developments. So yes, you're right. You've got to look past the oil and gas. There's even platinum.
Then let's move on to Brait. Because in my mind, Marc, this is Virgin Active. When I think Brait, I only think of Virgin Active, and I could, be downplaying what's happening in this portfolio. But I'm keen to get your thoughts here, also just on Brait's future and Virgin Active, the post-COVID-19 recovery. Has it been a recovery?
Yeah. Look, I mean, yes, you talk about Virgin Active. That is the story there. And I mean, sometimes with Brait, I want to cover my face in shame because I've been backing this thing, hoping for a value unlock, and it's just dragged on. And but the reason I picked it now is that just near the end of last year, the share price gave way badly. It's down to, I think it went down to 160. In fact, the last NAV, the undiluted NAV was about close to R7, 685, something like that. And I think on a diluted basis, but what I mean by diluted basis, if they convert their convertible debt into equity, I think it comes down to maybe under R6. But that compared to the current price, that seems staggeringly high. But you've got to remember that there's a cost to these convertibles. The shortfall, there's a conversion price. I think it's close to 440 cents or something. So the shortfall between the current share price and that share price has to be forked out by Brait. So that's another cost to them. So the share price is not taking things well. And a lot of this now hinges on Virgin Active. Because Premier, as you know, is a decent business. That's the other big asset. That's done nicely. It is doing nicely. We saw the AVI trading statement yesterday, and maybe it's good news for food companies this year. Maybe they're going to do better. But Virgin Active has to show that it can move up to those EBITDA levels that they had pre-COVID. And it's doing it pretty slowly. I think the last count, they were doing £3 to £4 million a month. You annualize that out, you're looking at 36, maybe £40 million a year. It's not bad, but it's not up there at that 120 million level that they had before. So Virgin Active really needs to prove itself. I mean, anecdotally, I go to gym. I went yesterday. I complained to my daughter, said, let's just go. I can't get on any machines. That's so full. So okay, that's the beginning of the year. People do come back from their Christmas holidays and want to train hard in gym and sort themselves out. But it does seem like the gyms are doing okay. And I hope they can show that in the results, their upcoming results. I think their trading update comes out early March, which should give some kind of indication of how they're doing. I think any kind of slowness on that recovery is going to cost them a bit, and the market will be disappointed.
Also, I have New Look within there. I came to find out about that business. How big of a portion is it there, within the portfolio? And is that a business worth looking at there? Is there value sitting with New Look?
Well, look, I think New Look's come back from where it was. I think it was in terrible trouble at one stage. The exposure to Brait, unfortunately, is very small. So if it does continue its recovery and do well, the UK market's quite tricky and fickle in that fashion retailing sector, but it's not big in their life. I think it might be 6, 7, 8% of their NAV. So if they do offload that or sell it in the interim, it's going to raise a couple of 100 million rand or so. Not big. The big thing still is Virgin Active. That's, as I say, that they've got to get traction there quickly, without a doubt.
An interesting one here is, I think there's been lots of criticism around EPE Capital Partners' role within Brait there. I think one of analysts, I forget his name, and I know his surname is Falloon, he said that EPE is just there for fees. And the issue of fees is actually a big one with holdcos. I'm keen to get your thoughts on this one, specifically where Brait is concerned.
Look, that is always the case with holdcos. The fees are a prickly little issue, and people don't like them. And I suppose, with what's happened at Brait and EPE's, look, you've got to step back. I suppose when Brait was managed by its own management company, they were earning huge fees. EPE came in, they did that restructuring, they changed it, they reduced it drastically. But they're still earning a fee and still earning a decent fee. So while Brait drags on, there's always going to be that criticism. What EPE has done in the interim, I think after those comments were made, is they have said they want to unlock value. Hopefully Brait forms part of that. It's a good little chunk of their portfolio. They've got other big assets as well in fintech, so who knows what they're really up to. But one hopes that translates down to Brait, and there is some urgency in doing this. I know every time I sit to the Brait analyst presentation, it seems like some of the shareholders, some well-known shareholders, get more and more tetchy every time, and are starting to get quite angry now. But it's not something I suppose you can rush. A recovery is a recovery, and you can't just list Virgin Active if it's not doing well or not performing. So there are those issues. So it's an interesting one to watch.
And I must ask you, Marc, I may be, in my mind, Virgin Active could be smaller than it actually is. I know here at home, for instance, it is a dominant brand. We have lots of other little small private gyms emerging, Planet Fitness and the like. Globally, is a Virgin Active big, if you look at the other territories where it operates?
I think it is fairly big, yes. I mean, I haven't looked at comparative numbers or comparative gyms. I know there are big gyms. There's some big gym chains, especially in America. I think some in Europe as well. But it's certainly a brand that's big enough to attract the attention of another gym chain in terms of acquiring it, and which would be an interesting development. And adding to, it's got as you say, a dominant foothold in South Africa. It's doing awfully well in Italy. That's the one part it is doing well in. UK, less so, but it does give footprints, and there's an opportunity there. Certainly, it's got Australia as well. So you're buying a fairly big global business. You're getting something out of it, and possibly even something that could be sold in parts, I guess. That's big enough in that regard. So yes, it has got scale.
Well, with that said, Marc, keen to rank these for our retail investors at home. In which order would you go into these stocks?
It's a real tough one. the moment, to be quite honest with you, I'd be watching all three. If you asked me to, with a gun to my head, put your money somewhere, I'm going to say it again, Brait. I'll probably live to regret this, but yes, I'm going to go for it. I just got to believe they're going to do something this year, and some kind of value will be unlocked. Then I'd go for HCI and Reinet.
Okay. And then, of course, in our educational segment, we do have a share split and share consolidation. Help us understand these terms, please.
All right. Very typically, and this is a gross generalization, so please don't take me at my word here. Share split normally happens when a company is doing fairly well, the share price has grown, it's got to a level where it might be R1,000 a share, and maybe feel that retail investors or investors, it's expensive to buy in bulk. R1,000 for someone who's a small investor can't buy it, so they'll split the shares 10 for 1. And the share price will drop to 100. The shares in issue will increase by the same amount. There's no change in value. It's merely a mechanism to change maybe the ease of trading to help shareholders. It's, for instance, Naspers. It's almost 2,000, 3,000 rand. Buy one Naspers share is a lot of money. So if you buy through easy equities on a fractional basis, you buy 1.5, but you're not going to get a dividend on the half share. So it's not really great. I kind of wish that Process and Naspers would split their shares, maybe AB InBev as well, and some others who are trading up there in those thousands. Richemont, for instance, it's very expensive for a retail investor to buy in bulk there. Consolidation, generally speaking, comes when a share price has plunged horribly, and at 1 cent or 2 cents range, it's not really practical to trade like that, and they will increase it by tenfold, by 10 for 1, for instance. Again, the value doesn't increase. The pool of shares shrinks and the value increases on the share, but not in shareholders' value. It's not always the case that it's companies in trouble. I mean, we've seen companies do that, like Reinet, Richemont as well, I think. Unpacks did it recently, a couple of others that I can't recall now. But it's normally if there's a corporate action, maybe like a rights issue, better to have the higher price, issue the shares at, than it's trading at 3 or 4 cents.
And before I let you go, Marc, I'm actually keen just to get your thoughts. I haven't spoken to you in 2024. Themes for 2024, what you're looking out for, especially where small caps might be concerned.
Yeah, try and look for value in well-established companies. I'm thinking of companies, something like New World has been around a long time, Transpaco, Bola Metcalf, etc. If you're looking at that small cap space, you're hoping for corporate action, at least by a company that is paying dividends, churning cash flow, and is profitable in a good niche. Because sometimes these things don't always happen. You say, this company's awfully cheap, it's certainly going to get bought out. We said that last year. Nothing happened for most of those companies. So make sure you're getting the dividends at least, and that the company's on a decent footing in terms of growing. But I think it could be the year where a couple of very cheap companies get taken out. It can't go on like this. Some of them are trading at such levels, it's quite baffling.
Well, Marc, it's been a pleasure hearing from you. Thank you so much for chatting to us, and looking forward to chatting to you in a few weeks. Thank you so much. That was Financial Mail's Marc Hasenfuss.